Good evening, everyone. On behalf of Dadri CP Study Circle, I welcome you all to the today's webinar on TDS implications on foreign remittances. Friends, we are facing a challenge in terms of deduction of TDS on various foreign remittances. Day by day, there is increase in the volume and the values of the foreign remittances that are made. Government is generally tracking foreign remittances, and also when money goes out of India, there is no hand for the government to collect revenue. So government is imposing burden on taxpayers to deduct TDS. And as a chartered accountant, we need to give a certificate in Form 15CB, which includes deduction, rate deduction, and what will be the DTAA application. So we thought it would be a right topic, and we have with us Namrata Dedhia will be guiding us through the provisions. I request everyone to put their questions in the chat box throughout the session so that we can take up relevant questions at the same time. Before we start the session, I request Parin to play ICI motto.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you, Parin. Now I request Pratik Shannan to introduce Namrata Dedhia.
Thank you, Rahul Bhai, for giving me this opportunity. It's a pleasure for me to introduce our today's learned speaker, CA Namrata Dedhia. She is practicing as a partner of Shah and Dedhia Associates, and she practices in the areas of direct tax advisory, compliance, appeals, FEMA advisory compliance, transfer pricing, taxation of cross-border transactions. She has a rich experience and specializes in transfer pricing and international taxation. She has advised clients, including startups, on the structuring of investment tax and transfer pricing implications of the same, developing transfer pricing policies, regulatory requirements under income tax and FEMA. She qualified as a chartered accountant with 17th All India rank in CA final, 7th All India rank in CA PE1 exam. She qualified as a company secretary with 4th All India rank in CA final exams, 23rd rank All India at the CS Foundation exam. She has spoken at different forums on topics relating to transfer pricing, FEMA, and taxation, and also contributed articles of professional interest to journals and various newsletters. She is member of International Taxation Committee and Research and Publication Committee of Chamber of Tax Consultants and the International Taxation Committee of BCAS. With this brief introduction, I welcome CA Namrata Dedhia on behalf of Dadari CP Study Circle. Over to you.
Thank you, Pratik. Before Namrata starts his talk, I request Parin Gala to present e-certificate to Namrata.
Thank you, Rahul. Namrata, with this tough times of COVID, of course, now we are all into a normal phase of life, and we hope so that everyone continues to be in such phase. This is an e-certificate on behalf of Dadari CP Study Circle and all the members. We would like to present you and thank you for accepting our request for being as a speaker on the relevant topic of foreign remittances.
Thank
Please
you.
accept
Thank
this.
you, Rahul. Yeah. Thank you. Thank you, Pratik, also for the introduction.
And Namrata, you can start now.
Yeah, I'll share my screen first.
Yes.
So, as Rahul and Pratik and Pareen were mentioning, it's been a while since I interacted with other ECP study circle, either on either sides, and it feels good to be back. And I see a lot of familiar names in the list of participants. So had this been, I'm now feeling, had this been a physical meeting, it would have been much better to see all those faces and meet and greet all the people that I've known since a very long time. Nevertheless, I hope, like Pareen said, things are slowly getting back to normal. I'm hoping some of the meetings will start becoming offline soon, just for the joy of meeting and discussing things in person. So the topic for today, as Rahul mentioned, is quite a practical topic and something that almost everyone of us has started feeling a need to understand now that foreign remittances have become very common. Gone are the times when this was a topic purely meant for international tax practitioners, and since most of our clients are now making some or the other form of foreign payments, the evaluation, and to add to that, the increasing complexities in law, the widening tax net requires all of us to understand at least that what situations could attract TDS, maybe what care we need to take when certifying the Form 15CB and generating Form 15CA on behalf of the client. What are the possibilities where we may or may not have to understand what are the tax implications under the DTAA, what are the tax implications under the Act, and to add to it, of course, what documentation we should take care of, both from client perspective, what we should advise them, and as a CA certifying 15CB, what we should take care of ourselves, so as to make sure that we do not end up issuing any false certificate. We all understand that now we have a onerous responsibility of certifying on ourselves, considering the penalty under 271J for false certification. So at least the attempt in today's session is going to be at least to create an awareness of what all circumstances, under what all circumstances we would, or there could be a potential TDS liability, and therefore we may need to examine in deeper detail any possibility of such a TDS liability. Then, of course, the subject is never ending. The more you study it, the more the nuances come out of it, especially when you start looking at each individual type of payment, such as royalties or fees for technical services, etc. So as you get into the depth, you will encounter more and more complications, which probably then you'll have to study, make a deep dive and study more in detail. So with that background, let us understand the provisions and the framework relating to TDS on foreign remittances. So broadly, if I have to look at the provisions, then Just a moment. Yeah. Okay. So broadly, the basic framework or the basic provisions relating to TDS on foreign remittances or payments to non-residents, more specifically, is primarily the primary section that deals with this is section 195, and of course, to along with section 195, we have also need to look at 195A for grossing up, 206AA for rate of TDS in case a PAN or a TRC of the non-resident is not available. And then there are additional sections for specific situations of TDS, such as interest payments, which are covered, interest on either ECB low borrowings or rupee borrowings from non-residents are covered under 194 LA, LB, LC. Then you have 196. So there are certain specific payments which are covered in different sections. But if I can use the word, the main section surrounding covering TDS on payments to non-residents is section 195. So if you've understood 195, a lot of the aspects of foreign remittances get covered. So 195.1 is creates the charge and lays down what will be or in what circumstances TDS will be applicable on payments to non-residents. 195.2 and 3 deal with situations where a lower or a nil withholding tax may be required, and therefore they provide the framework for allowing an application whereby a lower TDS or a nil TDS can be done. 195.4 will deal with the validity of that certificate issued under 195.3, and similarly 195.5 is also about rules that can be made by CBDT. 195.6 is where we come in, which is the certification that we need to issue in Form 15CB, and based on that Form 15CA that the client has to generate and submit. So 195.6 is the section which is the base for issuing Form 15CB and generation of Form 15CA. Based on this section, these forms or this documentation is created to be submitted to the AD banks. Then we have 195.7, which empowers CBDT to make rules for making application to the AO for determining how much of the sum is chargeable to tax. Let's look at these provisions a little more in detail. So we have 195.1. Broadly, if I have to break up 195.1, that is the applicability of TDS on payment to non-resident. It deals with one, who should deduct. It deals with the nature of payment, what types of payments are being covered under this particular section, at what point of time deduction is required, and at what rate the deduction is required. So who should deduct? Any person who is making payment, who is responsible for making payment to a non-resident or to a foreign company, is required to deduct TDS under section 195. If I were to compare this for better understanding, we'll keep on comparing the domestic TDS provisions with 195. So we have a distinction in front of us. So the domestic TDS provisions, of course, require any person making payments to deduct TDS, but there are also a lot of exclusions there. Whereas in 195, none of those exclusions come in. So if you are making personal payments, your domestic TDS provisions will not apply. If you are making payments, if you are an individual or an HUF who is making payments and your turnover does not exceed 1 crore turnover from business, then in that case, again, you are not liable to deduct TDS, which exception or which exclusion is not created under 195, which means that any individual who is making payment to a non-resident, subject to the other conditions, of course, of this of 195(1), any person who is making payment to a non-resident or to a foreign company will be required to deduct TDS. So it is as simple as you and me as individuals downloading let's say music from a website which is owned by a foreign company, or from a website where payments are being made to non-residents. Even those payments on a very basic plane will attract TDS under section 195, irrespective of the fact that we are downloading that music for personal consumption, or we are making those payments for personal consumption, or the fact that as individuals we are not liable to tax audit, or the new condition, the changed condition of turnover of 1 crore. So despite that, the TDS provisions will apply. Not just that, even when payments are being made by one non-resident to another non-resident, explanation 2 states that it will also attract TDS under 195. So of course, payments by one non-resident to another non-resident which are completely outside the gamut of the Income Tax Act will not attract TDS. It is when the Income Tax Act becomes applicable to that amount, and the amount is a sum chargeable to tax under the Act, that 195 will be attracted. But the fact that the payment is being made outside India between two non-residents is by itself not a reason to not apply section 195 and not deduct TDS on that particular payment. What type of payment are we talking about? We're talking of any interest, which will of course exclude interest under 194 LB, LC, LD, because these three provisions apply to interest payments to non-residents, but they are specific TDS provisions. Interest payments to non-residents on either rupee borrowings or external commercial borrowings, etc. So because these are specific sections covering interest payments, the interest which is covered in those sections will not be covered under section 195. So TDS on such an interest will not be covered under 195. Other than that, any other interest payments will be covered under 195. Any sum chargeable to tax under the Act. So again, going back to the domestic TDS provisions, we have so many sections under the domestic TDS provisions, each dealing with a different nature of income. Unlike that, under 195, it is an umbrella section. So with a few exceptions of 194 LB, LC, LD, 196, etc. With those few exceptions, leaving out those few exceptions, every payment made to a non-resident will get covered under 195 as long as it is a sum chargeable to tax under the Act. So the only trigger for 195 compliance is that it has to be a sum chargeable to tax under the Act. Nothing else matters. What type of income doesn't matter. Who is the payer doesn't matter. What is the purpose of the payment, whether it is for personal consumption or business consumption, doesn't matter. What needs to be evaluated is the payment being made to one, a non-resident or a foreign company, and two, is that payment a sum chargeable to tax under the Income Tax Act for that non-resident or for that foreign company, for the recipient. If these two conditions are satisfied, 195 will get triggered. And it of course does not include salary or dividend under section 115O. Dividend under 115O for obvious reasons, that it attracted DDT and therefore it was not taxable at all under the Act. Now with 115O no longer being applicable, dividends per se, which have not been subjected to DDT, will be covered under 195 again. And salary is excluded from 195 because 192 covers all salary payments, whether the recipient or the employee is a resident or a non-resident. So even salary payments to non-resident employees is covered under 192 only, which means it will not get covered under 195. So bottom line is, at the cost of repetition, any payment being made by any person, whether resident or non-resident, if the sum is chargeable to tax under the Act, will attract TDS provisions under Section 195. So what we need to, whenever we are certifying for our client and when we are advising the client on the applicability of TDS, what we need to look at therefore is the sum, or is the nature of, is whatever payment is being made, is it a sum chargeable to tax under the Act? So evaluation of chargeability of that amount is the entire analysis that we need to do. What is the time of deduction? Similar to our domestic TDS provisions, at the time of credit or payment, whichever is earlier. If it is a transaction of interest payable by the Indian government or any PSU bank or public financial institutions, then in that case, the time of deduction will be at the time of payment, not at the time of credit. What are the rates of deduction? So we are used to, under the domestic TDS provisions, a fixed rate of TDS to be mentioned, 195, because it deals with a variety of payments, some of which may be fully taxable, partially taxable, etc. The rate of deduction is at the rates in force or as per the Finance Act or applicable DTAA, whichever is more beneficial. So we do not have a flat rate of tax which is prescribed. Depending on what is the nature of payment, we will have to go back to the Act and understand if in the Act any rate has been prescribed for that particular nature of payment. For instance, for royalty payments, for fees for technical service payments, you have specific rates, flat rate of gross basis taxation prescribed for these nature of payments. So if your payment is falling under those categories, you will apply that flat rate of tax. Versus that, you could have other payments to non-residents, such as probably a director sitting fees, or maybe an amount which does not fall under fees for technical services, but is rather a professional fee, which is more of a business payment or a professional payment to the non-resident. Now, in those cases, you do not have a fixed rate of tax which is prescribed under the Act, and you will have to then look at what will be the taxability of that amount, either whether it is a gross basis taxation or a net basis taxation, and at what rate, and accordingly determine the rate of deduction. So one is the rates in force, which is given in the Act. Two is we look at also the rate as per the Finance Act, and then we look at the rate as per the applicable DTAA. Because we are dealing with payments being made to non-residents, Section 90 subsection 2 will take us to the DTAA, and if the provisions of the Act are more beneficial, they will apply, else the provisions as per the DTAA will apply. So when we say, of course, we are talking about rate of deduction right now, but when we say provisions of the Act or DTAA, it starts from the point of taxation itself. We will evaluate whether a particular payment is taxable under the Act or not, under the DTAA or not. If taxable under either or both, what are the rates of tax, and then conclude as to what should be the final treatment for that. So a little more in detail, some of these we have probably already spoken about. So payment by any person is covered, including individuals or HUFs who are not liable to tax audit. Now this condition is linked to turnover rather than tax audit. Then payer can be a resident or non-resident, both. The responsibility of deducting TDS is on the person responsible for paying. Now, this a classic example here, or a classic situation here, is in case of payments being made to non-residents on sale of shares, where there is a capital gain that has arisen on those shares which are sold, and therefore, because there is income which is liable to tax under the Act, there is a responsibility to deduct TDS on that payment. Now, who deducts TDS in that case? If you read section 195(1) again, it says any payment, any person who is responsible for paying to a non-resident or to a foreign company is liable to deduct tax at source. So who, if in the case of payment being made to an individual or to a non-resident in case of sale of shares on which he has earned any capital gain income, who is the person responsible for paying? So the transaction that happens of sale of shares happens on the exchange, but the exchange would not have information nor have details of the particular transaction. If that person is a resident, non-resident, what was the cost of that person, and what is the TDS liability on that particular payment. So in such a situation, the exchange cannot be considered to be the person responsible for paying. The exchange is not privy to information which will enable it to undertake the compliance under 195, and therefore it comes back to the broker or to the usually, typically it will be the banker broker who will be undertaking the compliance for TDS. The bank at the time of crediting the amount to the broker will share this information of the capital gain figure with the bank which is linked to that account, and the bank at the time of crediting the amount to the account of the non-resident, which is the point of payment, they will deduct TDS under 195 and credit it to their, do the rest of the compliance of filing TDS returns, etc., and give credit to that non-resident. So the person responsible for paying need not be the person who is claiming that expenditure in their books of accounts, need not be the person who is actually bearing that expenditure, but the liability to deduct TDS under 195 is on the person responsible for paying. Payment to a non-resident, even in case of mutual funds. So if mutual funds are making payments, either redemptions or dividends, which are now taxable, then the TDS liability is being undertaken by the fund houses for making those payments. Because in case of mutual funds, the information is available with them as to what is the cost, what are the redemptions, what are the capital gains, if at all, or if there is a dividend income, then what is the income, and TDS is done by them accordingly. But the same is not possible in case of shares through exchanges, and therefore banks undertake that compliance. So payment to whom? To a non-resident who is not a company or a foreign company. When we say section 195 applies to payment to a non-resident, what about a RNOR, a resident but not ordinary resident? Now, if you think logically, the fact that somebody is a not ordinary resident is subsequent, but the person is a resident first. So if the classification under the Act under section 6 is clearly first as a resident versus a non-resident, and then under resident we have the subcategory of ordinary resident or not ordinary resident. So to my mind, the fact that you are a resident, even though you are a not ordinary resident, section 195 will not apply for payments being made to a not ordinary resident. The bigger issue in case of the residential status is at what point of time would you look at the residential status? Naturally, when you are making the payment or when you're crediting the amount in your books of accounts as payable to that non-resident, you are liable to undertake the compliance of section 195. You are liable to deduct TDS, and you are liable to subsequently make payment to the government, file the returns, etc. Now, supposing you're making the payment at the start of the year, sometime in May or June, you're making a payment to an individual who you have known to be a resident for a very long period of time. That person has in the last 5-7 years never gone outside India, and therefore you make the payment understanding that that person is a resident in India. You deduct TDS under resident under the domestic TDS sections, if at all TDS is deductible in that case, and based on that itself you undertake the rest of the compliance. Now subsequently, for whatever reason, the person has to leave India for good. Maybe in the month of July, the person has to leave India for good, and he becomes a non-resident in that year, in that financial year. What do you do in that case? Because if you look at the financial year for which the payment was being made, that person is a non-resident. and therefore you should have deducted TDS under 195, undertaken compliance also under 195. Instead, you have deducted TDS, but under the normal section, under domestic TDS provisions, and undertaken that compliance. So this is a practical difficulty which there is no final solution to, there is no clear solution to. One approach could be, of course, to look at to verify the residential status based on the preceding financial year, because at the time of making the payment of credit, that is the information that is available with you. You do not have information for the current year which is yet to get completed, so you cannot possibly determine you look at the preceding financial year. Based on that, you conclude as to the residential status and undertake the compliance. And added maybe documentation that could be created when you are making a payment to a person who could potentially, in your view, become a non-resident, is to get a confirmation or an undertaking from that person if they intend to continue to stay in the country for long enough time that they will remain a resident, or they have any plans to move out of the country. But this will end up being very what do we say? This will end up being not relevant if for any emergency reasons or if for any last minute decisions, the person has to leave outside India. Now, if he has to, just for the sake of that undertaking that he has given to you, he is not going to take care that he continues to be a resident in the country for that financial year and plan his movement outside the country accordingly. That is not going to happen. So even though you may try to take an undertaking or a confirmation for your sake, it may not really be of much value eventually if the person does become a non-resident. So at the point of making the payment of credit, you try and understand the situation as best as possible, create as much documentation as possible around the residential status, which may be the previous preceding financial year's residential status, as well as any indication as to the intention of that person to leave India for that particular year. And based on that, take a call as to how will you determine the residential status. Issues also arise where you are dealing with people who can be dual residents. You have a US citizen who is staying in India for more than 182 days. He becomes a resident of both countries based on the respective rules around residential status. So then from an India perspective, because that person is staying in India for more than 182 days, he's a resident. The fact that he's resident as per the Indian Income Tax Act, Section 195, therefore, should not apply. But he will also be a resident of the US and may be filing his returns in the US as a resident. So to my mind, we will have to, as far as residential status is concerned, we will have to look at the residential status as per Section 6 of the Act. If he is a resident as per the Act, you will have to continue with that status and accordingly apply either Section 195 or the domestic TDS provisions. So I mentioned at the start that, of course, 195 also has exclusions in that certain payments have specific TDS sections, and therefore those TDS sections will not get covered under 195. So we have 194 LD, LD deals with different types of interest payments in specific circumstances. Not all interest payments are excluded. Then salaries, dividends, all of these will not get covered. Payments for personal purposes are not excluded. We already discussed this. Also, unlike your domestic TDS provisions, there is no threshold limit. So you have a 30,000 per annum or a 30,000 per invoice or a 75,000 per annum limit under 194C, or you have limits under 194H, I, J. there is no threshold limit under 195, which means even 1 rupee of a payment, if it is a sum chargeable to tax under the Act, will attract 195. It is also applicable to rupee payments. The fact that you're saying that this is TDS on foreign remittances or TDS on payment to non-resident doesn't mean you have to make payments in foreign currency. Which currency is not relevant, to whom you're making the payment is relevant. And finally, section 195 is only a TDS section. It is not the final tax liability. So 195 may be used to discharge the TDS liability, and the taxability of the non-resident or the foreign company receiving that money will again have to be evaluated independently when they are required to, if they are required to file their return of income, and when they are required to file. So there are payments which are covered by specific TDS sections. Some of these we already mentioned. 192 we said. Then we have 194 B and double B, which deals with the windfall winnings of horse racing, lottery, etc. 194E covers payments to non-resident sports persons, entertainers, or sports associations. So those will not be covered under 195. We have incomes of units of business trusts, investment funds, etc. 194 LBA, LBB, LBC. Then we have income in respect of mutual fund units, which is 196A, also covered separately. And then payments which are made under 115 AB, AC, AD to offshore trusts, to FIIs, etc. They have specific TDS sections, which is 196 B, C, D. So again, they are excluded from 195. There are other items which are not covered under 195 or which are not subject to TDS. In fact, not just not covered under 195, they're not subject to TDS at all. Shipping income of non-resident shipping companies, it is taxable in the year itself under section 172, and therefore if the final tax liability itself is being discharged, the question of TDS on such payments does not arise. Capital gains income which is earned by FIIs, FPIs is not taxable under 196D2, and therefore the same is not subject to TDS. Interest which is paid by offshore banking units to non-residents or RNORs under 197A are also not taxable, so not subject to TDS. And then we have Equalization Levy, which was introduced by Finance Act 2016, a levy on certain types of foreign payments or payments to non-residents or foreign companies, which attracted a levy on the gross amount calculated on a flat basis. So in that, if equalization levy applies, then we have section 10 subsection 50, which states that it will not be taxable under the Act. There's an exemption given under 10 subsection 50. So if it is not taxable under the Act, it naturally will not attract any TDS obligations under 195. So to come back to what are the nature of payments covered, you could break down the nature of payments under 5 portions probably. One is payments which are not in the nature of income at all, which are more of capital payments, say a gift given to a relative or investments made abroad. Now, the fact that these are payments which are not incomes, but rather not even revenue items, but in fact capital items, there is no question of these amounts being taxable under the Act, and therefore 195 compliance will not apply. Certain items can be incomes, but not taxable under the Act, such as you have import payments. Of course, now we will come to this later. Import payments also, there can be a situation where you may need to deduct TDS on import payments. We'll come to that situation. We'll come to that discussion a little later. But broadly, when we say import payments, the general consensus is that in the case of pure imports, the entire activity of the non-resident or the foreign company is based outside India, there is no nexus to India except for the fact that the customer is in India, and therefore that payment per se, the entire profit out of that payment, the income of that payment arises outside India. So it doesn't remain taxable in India. If it is not taxable in India, it is an income item or a revenue item, let's call it that, but not taxable in India. Then you can have dividends which were earlier subject to DDT, were not taxable. You have NRE account interest, which is again in the nature of income, but not taxable. Now, all of these items, if they are not taxable, even though revenue in nature, there should be no obligation to deduct TDS under 195. And also, therefore, no other compliance also needs to be undertaken. Then you have items which are incomes, revenue in nature, taxable in India, but exempt because of a double tax avoidance agreement. For instance, you have payments which are probably in the nature of services under the Act. They get classified as fees for technical services, which are taxable at a flat rate. But under the DTAA, they are payments which are not getting covered under the definition of fees for technical services. They are probably payments, business payments. And because the non-resident has no permanent establishment in India, those business payments are not taxable in India. So these category of payments also exist. Now here, it is not a straightforward non-taxable item. If you look at the Act alone, it is taxable, but because of a certain provision of the double tax avoidance agreement, it is non-taxable. Now, in such a situation, even though TDS may not apply, for TDS not to apply, which means to avail the position as per the DTAA, there's certain documentation that you will need to undertake, that the client will need to undertake, which is, we'll come to that documentation a little in detail later. But broadly, the tax residency certificate, etc., for eligibility of the DTAA will have to be obtained from the non-resident. And once again, because it is not a simpliciter non-taxable item, it can be taxable under the Act, but not taxable under the DTAA. Consequently, you will also need to undertake 15 CACB compliance in case of such payments. Then you have items which are entirely taxable either on gross basis or which may be taxable on net basis. So gross basis taxation is mainly 3 items: royalty, fees for technical services, and interest payments, which the Act as well as most of the DTAAs will specify the rate of tax on a gross level. On whatever is the gross amount of payment, a fixed rate of tax will apply. And then you have incomes which are taxable on a net basis, which is items such as capital gains, business profits, where the whole amount being paid to the non-resident is not taxable, but a portion of it is taxable. So we'll again, how do you deal with such amounts? We'll come to that a little in detail in a few moments. Whether the TDS should be deducted on amount including service tax and GST or excluding service tax and GST. So we, of course, in the context of resident payments or domestic TDS sections, we have the CBDT circular, which clearly says that service tax element or GST element has to be excluded. Now, while there is no circular in case of non-resident payments, but what we need to understand is 195 applies in case of amount which is chargeable to tax under the Act. Service tax or GST on the non-resident payment is not income for that non-resident, and therefore it is not a part of income chargeable to tax under the Act. So TDS should not be on the amount including service tax or GST. It should be on the amount before service tax or GST. So by sum chargeable to tax under the Act.
Namrata, if you can just check the chat box.
I think I dealt with that. One question by Chetan Bhai, payment to FII, FPI. I dealt with that in 196D.
Okay.
There is a specific exclusion in subsection 2 for taxability of capital gains of FIIs, FPIs. So that will get excluded. So sum chargeable to tax, what do we mean by sum chargeable to tax under the Act? Basically, we need to understand that whatever payment is being made to the non-resident or to the foreign company, is it taxable under the Act or not? Once you determine it is taxable under the Act, then the TDS compliance under 195 applies. The moment you say it is not taxable under the Act, 195 TDS compliance does not apply. So what to look at is in the hands of the non-resident payee or the foreign company to whom the payment is being made, whether it is taxable or not. Now, logically, if the non-resident payee itself is an exempt entity for whatever reason, or the non-resident payee does not have any presence in India, is not chargeable to tax in India, then naturally TDS should not apply. However, we have the Supreme Court judgment in the case of Pilcom, where when tournaments were being played in 3 countries and associations of these countries were made payments from India, although those payments were not taxable under the Act, TDS provisions were applied in that, and Supreme Court has upheld that position, wherein it said that the obligation to deduct tax at source is different from the ultimate or the final taxability of that income in the hands of the non-residents. The stand taken or the ratio given in that judgment is that if the law requires that you deduct tax at source on a particular nature of payment, then you will deduct tax at source on that payment. Let the non-resident assessee, the payee, then file their return of income and claim that under the DTAA provisions or under, because of a certain exemption, they are not liable to tax on that amount, and therefore whatever is the TDS that has been deducted be refunded to them. So in Pilcom, the Supreme Court has bifurcated between the final tax liability and the TDS obligations, stating that TDS obligations have to be discharged without looking at the final tax liability in the hands of the recipient. However, practically, when you look at these any foreign payments that are being made, what the section requires, the bare reading of the section says, is that the sum has to be chargeable to tax under the Act, which means you will have to evaluate the chargeability under the Act. Now, Supreme Court in Pilcom has tried to harp on the fact that you have to look at taxability under the Act, discharge TDS, and then if the payment is not taxable under DTAA, then you claim exemption when the non-resident files the return of income for and claim exemption under the DTAA. But in my opinion, what has been missed out in that is that the Act itself facilitates you to evaluate the DTAA position. The Act itself allows you to access the DTAA and see if a particular payment is taxable under the DTAA or not through Section 90. And therefore, that is also a part of chargeability under the Act. Therefore, if a payment is not taxable under the DTAA, it should be excluded from the obligations of 195 also. TDS is also to be deducted where only a portion of payment may be income. So we touched upon this, where the whole of the amount is not taxable. Some business profits which are taxable in India because of a business connection in India or a permanent establishment in India, or maybe capital gains amount where the amount, the sale consideration may be X, but out of that X, only a small portion is the gain amount which is being which is liable to tax in India. Even in those cases, the TDS obligation under 195 arises. You look at 195(2), it says that where the whole of the sum is not chargeable to tax, then in that case, you will approach the AO to determine the amount chargeable to tax and discharge the TDS obligations accordingly. So that means the fact that if I'm paying 100 to the non-resident and the entire 100 is not chargeable to tax does not mean I am out of the need to discharge 195 compliance. I will still need to deduct TDS. I may have to determine the portion of the amount which is income and deduct TDS on that. Or if that is not clearly available, then I have to approach the AO under 195.2 to determine the portion which is taxable and accordingly deduct tax at source on that portion only. So we have several Supreme Court judgments, Transmission Corporation, GE India, which says that where the whole of the amount is not taxable, then you will not deduct TDS on that gross amount. You will determine the amount which is taxable, and based on that determination, you will then discharge the TDS obligations. So I took the examples, which is sale of property or capital assets, business income, etc. Now, sale of property is a very common transaction that is happening, especially in the last few years, and this is where 195 also comes in largely. So if non-resident sellers are selling property or assets in India and earning capital gains out of the sale, then the buyer is required to discharge TDS obligations under 195. Now, the first and foremost problem here is lack of awareness that the section that applies in such a case is not 194IA, which applies for purchase of properties from residents, but the section that applies is 195. So the first thing that needs to be understood is the resident buyer who is buying that property from the non-resident will have to obtain a TAN, deduct TDS under 195, pay it to the government, file a return under 27Q, and discharge the obligation of making the payment. So 195 applies. Now, once you say 195 applies, how do you calculate the tax? How do you deduct TDS? Now, long-term capital gains, I'm assuming for the time being that it is a long-term capital gain on the sale of property. So long-term capital gains, we have a fixed rate of tax given under the Act. We know that the rate of tax is 20% plus surcharge plus cess, depending on what is the income bracket or what is the amount of income. So we know the rate of tax. The question is on what amount to deduct. If you are making a payment of 100 and out of that 100, 20 is the capital gain amount. Will you deduct on 100? Will you deduct on 20? Now here, from the buyer perspective, if you're the person making the payment, you have to understand that the law doesn't authorize the buyer to determine how much income is taxable. The law says 195(1) says any person responsible for making payment is required to deduct tax at source on that payment. 195(2) says if the whole of the payment is not taxable, not chargeable to tax under that, then you go to the AO and ask him to determine how much is chargeable to tax under that and deduct TDS accordingly. So the law is very clear. You may come to a conclusion that the whole is not deductible, whole of the amount is not chargeable, but you cannot come to the conclusion of how much is chargeable. So the ideal way in that is to approach the AO, file a application under 195(2) or 197. 195(2) will be by the buyer, 197 will be by the seller. Ask the AO to determine the amount which is chargeable to tax under the Act, and on that amount deduct the TDS. Now, the practical difficulty in that oftentimes is the time involved. So sale of property typically will be a transaction that once you have decided, the buyer seller have negotiated, the transaction would most probably get over within a span of 15 days or 1 month, especially where the seller is a non-resident, because the non-resident may have come to India for a specific visit only to sell the property. He may have, once the negotiations have happened virtually or on call or through the broker, the non-resident would come to India specifically to obtain the payments, to register the property and get over with the transaction. Now, in such cases, that time is of essence. And practically, even if the law says that application under 197 has to be discharged within 1 month, it doesn't so happen, because the period of once the queries are raised and you file a response to those queries are excluded from that period of 1 month. So that itself adds easily another 15 days, 2 to 3 weeks to the process of obtaining the lower TDS certificate. So practically, it becomes a difficult situation where time may be lost because of this application under 195(2) or 197. Also, not just the time aspect, there is also the aspect where you don't want to get into the hassle of going to the officer, getting the certificate, giving him all documents, responding to 2 or 3 rounds of queries which are raised by the officer, and incurring all that entire, going through that entire process. So if that be the situation where because of practical difficulties an application for lower TDS is not possible, then of course from the buyer perspective, we advise the buyer, whoever is liable to deduct TDS, to always err on the side of caution and to take a conservative stand. And what would that conservative stand be? So in that situation, the advice to the buyer or to the payer typically is to deduct TDS at the applicable rate of LTCG, or that is 20% plus, on the entire amount payable, which is on the entire sale consideration. So in our example, on the entire 100 rupees, deduct TDS at the applicable rate for long-term capital gains. Let the seller then file his return of income, claim credit of that TDS, and claim refund of that whatever is the excess amount of tax. That works in favor for both. The buyer is not non-compliant with the TDS provisions. He has discharged his obligation of deducting tax at source and giving credit to the non-resident seller. And the non-resident seller can file his return and claim a refund of the taxes. The non-resident seller doesn't have to specifically go to the AO, get the income determined, and get the certificate, etc. Of course, that is not the ideal way to go about it, but a lot of times we see practically there are difficulties, and therefore this can be a solution. The flip side of this is naturally that since TDS is deducted on the entire sale consideration, there is a cash flow issue for the non-resident seller. So instead of determining capital gain at 20 and deducting tax on 20 at 20%, which is 4 rupees plus surcharge plus cess, of course, you are deducting that 20% tax on the entire sale consideration of 100. So you are deducting a tax at source of 20 rupees for the non-resident seller. So the non-resident seller will have to deal with that difference of cash flow, and he will get the refund only after he files the return of income, and probably 15 days, 1 month. We know the processing time for returns is not even as of now, and a larger refund could take some more time. So the non-resident seller will have to wait till that point of time till he to claim the refund of tax. So you have to weigh out, the non-resident seller will have to weigh out, is he okay with expediting the transaction initially by not applying to the AO, or is he does he prefer to have a lower TDS to start with and not have to claim a very large refund subsequently? Okay, there are 2-3 questions here which I'll take. So since the literal interpretation is going beyond Supreme Court decision of PILCOM, if someone doesn't deduct TDS since there was no sum chargeable to tax, what would be the consequence? Payal, yes, PILCOM is a Supreme Court judgment and therefore becomes the law of the land. The Supreme Court judgment says you look at the TDS obligation under the Act only, and let the if any exemptions or benefits are there, you let the recipient claim the refund for excess tax deducted. But to my mind, the practice still is, and that is a valid practice, considering that the law does not require you to evaluate taxability purely under the Act, but it encompasses the taxability under DTAA also. It is a valid practice continued even now to deduct TDS after considering both positions, which is the Act as well as the DTAA. So I would say if you have properly evaluated as to the liability under the Act as well as the DTAA and come to a informed conclusion with necessary documentation that the amount is not chargeable to tax under the Act and accordingly not undertaken any obligation, then there would not be any consequence. But of course, the documentation is of importance here. One more question is, what would be the TDS rate if out of two co-owners, one is resident and another is non-resident? What would the amount of LT, I think you want to write LTCG, would the amount of LTCG be split? Also, it would be good if you can touch upon 50 lakh limit is applicable for each owner separately in case. So let me go reverse. The 50 lakh limit file does not apply for non-resident payments. It is under, that limit is given under 194 IA and it applies only for property transactions that you enter into with residents, not non-residents. Not getting into the details of that because it is outside the gamut of our session today. But my personal view in that is that the 50 lakh limit applies to each co-owner separately and not qua the property. It applies qua the payer. That apart, if you are talking of TDS rate in case of two co-owners, one is resident and one is non-resident, then you will have to apply separately the domestic TDS provisions and non-resident provisions to each of the co-owner. See, for property, I think we have always been taught right from the start that to the in case of co-owners of property, to the extent of your share of the property, you are 100% owner. So if you one house property is owned by two people and each is a 50% owner, then to the extent of their 50%, they are 100% owners. So you will have to treat that each share as a separate property, hypothetically, and discharge the TDS obligations for each separately. The resident 194 IA, you will evaluate and accordingly discharge the obligation. And for the non-resident, you will look at 195 and accordingly discharge the obligation. I assumed 50% here, but facts may lead to a different conclusion. It may be a 1/3, 2/3 ownership, or at times the name of one person is only added for convenience, but the economic owner is only one of the persons. So a lot of times we've seen this happen where you may have father, son as co-owners or husband, wife as co-owners, but 100% of the payment has been made only by one of the persons. The other name is there only for convenience sake. Now, in those situations, you have to go by who is the economic owner and accordingly apply the provisions. Hiten's question is, who should apply for determining capital gain, buyer or seller, which is better from practice point of view? So the law allows both to apply. You have 195(2), 195(3), 197, which allow buyer and seller to apply for determining not capital gain per se. These provisions allow you to apply for either lower deduction of tax at source or nil deduction of tax at source, and in the course of that determine the taxable income. So law allows both. There is nothing saying who should apply, but practice point of view, what is better? The seller applying is better, because when you apply, whichever section you go under, you will have to give details of the person who is earning the income. You will have to give his PAN, his documentation to prove his residential status, which is copies of passport. You will have to give his income details for the last 4 years. You will also have to provide the details of that transaction, which is, if you're talking of capital gain on sale of property, then the purchase documents of the property, any cost of improvement, the estimated income calculation, etc. If there is any other income of that seller, and he's maybe, if he's filing returns in India because of some other income that he has, then you'll have to also add that to the estimated income and accordingly calculate the estimated tax liability. So all of that information will be very readily available with seller, one. Two, the seller may not be comfortable with sharing all of that information with the buyer for the sake of this application. So practice point of view, the seller applying does end up being a better proposition. if non-resident is buying another residential house, whether TDS is to be deducted. So now this is a situation which is quite common. We have a person selling one house and versus that buying either another residential property, so eligible for exemption under 54, or maybe buying the capital gain bonds, the exemption bonds, not the capital gain bond, but the exemption bonds under 54E. So 54 EC. So because of either purchase of the NHAI, PFC, REC bonds, or because of purchase of another property, the capital gains is per se not taxable under either 54 or 54 EC. What should you do as a seller, as a buyer? Would you should you deduct TDS or not? So purely from the non-resident perspective, he has sold the property, earned capital gains, is planning to reinvest in either another property or in the bonds. So there is no taxable capital gain. But as a buyer, how do you discharge your obligations? You have to understand what is the, to what extent would you consider an expected exemption for the non-resident seller? So there can be two scenarios. One, if it is a situation of a bond or a residential property, then the non-resident seller has already invested in the bonds when you're making the payment, before you're making the payment. Then you know clearly that because he has already invested in the bonds, which has to be done within 6 months of the transaction, then he's eligible for deduction under 54 EC. Then in that case, you give him the benefit of 54 EC, conclude that there is no capital gains at all, and arrive at the conclusion that there's no capital gains and take a stand that no TDS is to be deducted. Alternatively, if he's talking of buying a residential property, then naturally finding another residential property, buying another residential property is not going to happen within the short timeline of you buying the property from the seller, and I'm talking from the buyer perspective. So it's not going to happen within the timeline of you buying the property from the seller, making payment to him, discharging TDS obligation, and in the meanwhile he finds another residential property. That is not going to happen in 99.9% of the cases. Very rarely it would so happen that they would have identified another property already and immediately purchase that and be eligible for Section 54 exemption. So the only other way you can be, as a buyer, you can be sure of the exemption is that if the non-resident seller deposits that amount in the capital gains account scheme. Now, if that is the situation, then you can, again, based on the deposit of the capital gain amount on the capital gains account scheme, you can take a stand that the capital gain is not taxable and therefore no TDS obligation needs to be discharged. Another scenario that you have given is buying a property before the sale, which is 1 year prior exemption under 54 that is allowed. So yes, of course, if the property is already bought and it is eligible for 54 exemption because it is bought 1 year before the sale transaction, then in that case, you know for sure that the seller is eligible for Section 54 exemption, and you can take a stand that Section 54 exemptions will apply. Capital gain is not taxable, no TDS obligation arises. The other scenario is you ask the non-resident seller to deposit that amount in the capital gains deposit account. Based on that, claim the exemption and conclude that TDS obligation does not apply. Anything other than that, which is where the non-resident seller intends to invest in the bonds or intends to invest in the property or gives you a declaration or an affidavit that he will invest, will not be advisable to be considered as a basis for giving the exemption benefit to the non-resident seller. In those situations, it is better, again, like I said, to err on the side of caution and deduct TDS on the payments. If the cost of the new flat is higher than the old house itself, again, same thing, I think. The bottom line is you should be able to verify that the exemption is really available and not just rely on the word of the non-resident seller. Okay. So On the sum chargeable to tax portion, even there are CBDT circulars which state that it is the CBDT understanding is also quite clear that even if you have defaulted, if you are an assessee in default, then interest which is chargeable under 201 for delay in deduction or for delay in payment of TDS will be only on the portion which represents income, not on the entire amount. It also says CBDT Circular 3 of 2015 also says that disallowance will be on the sum chargeable to tax and not the whole. Make it that the obligation has to be charged only on the portion which is chargeable to tax under that and not on the gross amount always, unless of course the gross amount itself is taxable. So chargeability, quickly, I think we broadly did discuss this. Looking at the time, just a quick run through. You will look at the residential state first. When we are talking of companies, we also have to consider POEM, permanent establishment presence. So it may be possible that it's a foreign company, but because of POEM, it becomes a resident in India. Then you are out of 195. It may be possible that the company is incorporated in country A, but because of POEM, it is a resident of country B. Then you will complicated. You will have to try to understand which treaty to apply if you are availing treaty benefits. You will of course try to obtain the tax residency certificate and see if based on that tax residency certificate, you can take a stand of which treaty to apply. Once you have some clarity on the residential status, you examine the taxability under the Act. You go to Section 5, Section 9, see whether that income is taxable or not. If taxable, what is the nature of income? What is the rate of tax? Then you also look at the taxability under the relevant DTAA. Under the DTAA, you will first look at whether the person is eligible for that DTAA or not in the first place. Whether there is any limitation of benefit clause the DTAA which prevents from or there may be conditions. You need to check whether the person satisfies those conditions, therefore is eligible for DTAA benefits. And you, of course, now in the last 3 years, will also have to look at the MLI implications, which is the multilateral instruments wherein DTAAs have been redrafted without actually renegotiating those treaties with each individual country. MLI is a just briefly for the benefit of those who probably have not understood this concept earlier. MLI or multilateral instrument is a broad framework wherein countries who are signatory to that multilateral instrument agree to modify their treaties with other countries, certain clauses, certain articles of their treaties in certain manners. So there can be multiple combinations of how the treaties are modified. Now, naturally, a treaty is a contract or an agreement negotiated between two countries. It cannot be modified by one country saying, I want to modify it. So let's say if you're talking of a treaty between India and UK, it cannot be modified by India saying I want to modify it, but UK not saying UK saying I don't want to modify it. So for the India-UK treaty to be modified, the simple way is for both of them to renegotiate the treaty. But India alone has a network of more than 85 treaties. You have other countries also which have multiple treaties, and because of that, it is not possible for all treaties to be renegotiated where certain common abuses were sought to be dealt with through the treaties, which is why the concept of multilateral instrument where all countries came to a common draft of what modifications they would like to the treaties for avoiding these abuses. A lot of abuses that happen through the treaty, primarily one of the common ones that we know is of treaty shopping or body shopping, where you set up an entity in a favorable treaty jurisdiction just to take benefits of the treaty. So these and other abuses were sought to be curbed through MLI, where countries, whoever signed the MLI, will agree to apply the provisions of the the modified provisions as per the MLI to their treaties, and therefore, instead of reading the DTAA as it was originally, you will have to look at whether in our example of India, UK, you will have to understand whether India has signed the MLI, UK has signed the MLI, and from what date both have agreed to modify their treaties. Based on that, you will have to then read the modification into the treaty and apply the modified provision of the treaty to understand whether a particular item is taxable under the DTAA or not, if taxable, what rate, etc. And then finally, once you have understood the taxability under the Act as well as the DTAA, then thanks to Section 90 subsection 2, you apply the provision which is more beneficial based on certain documentation, of course. In order to apply DTAA, we do need the tax residency certificate to ensure that the payee is eligible for that DTAA. Okay. So Section 9, I have quite a few slides on Section 9, but I will not go through Section 9 in detail, just touch upon this, because I think more important would be to understand the TRC, the play around TRC 206 AA and 15 CACB compliance, etc. So we'll spend more time there considering what time we have on hand. So Section 9, of course, we evaluate when we talk of understanding the taxability under the Act. We look at whether income accrues directly or indirectly through or from a business connection or property or asset or source of income in India, which includes indirect transfer of capital assets, which was the amendment introduced post the Vodafone case. Business connection, we are all aware, in a layman term, a concept parallel to permanent establishment, where a non-resident has a connection in India through which he's earning income. There is no inclusive or exhaustive definition. There is no exhaustive definition of business connection. It is a very subjective concept which over time has been explained by courts. What is important is that because it is a business connection, the element of business should be there. Once in a while connection cannot be considered as a business connection. And if you do have a business connection, then your entire income from India is not taxable in India. It is only the amount attributable to that connection. If let's say the connection is in the form of an agent in India, then only the amount attributable to that agent will be taxable in India. Or if the connection is in the form of a branch in India, then only the income which is attributable to that branch will be taxable in India. It is deemed to accrue or arise in India under Section 9(1). 911 also clarifies that no income is deemed to accrue or arise in the case of mere purchase of goods. Purchase of services, no such exemption is provided, which to an extent is also logical, that if it is an activity for pure purchase of goods, you know that the entity in India is purchasing and just whether agent or any other entity is purely purchasing and exporting to the non-resident. But services would normally not be, this would not be the situation. You will not have a case where you purchase service and export them. The service provider might as well export them directly. If you are purchasing services, there's a likelihood so there is no exemption surrounding services. You have the agency concept under business connection, where you have an dependent agent who is dependent on the non-resident economically, and who undertakes activities of either habitually concluding contracts or habitually securing orders or delivering goods. Then in that case, that dependent agent is considered as a business connection. You coming 9(1) only. just a quick case study on this. You have, let's say, an Indian company which is incorporated to coordinate between the foreign company, which is the parent, and the customers in India. All the detailed product is price the specifications of the product are being provided by the Indian company to the customers in India. But whether to sell, at what price to sell, at what terms to sell, are all the final decision is taken only by the foreign company. The goods are exported by foreign company to Indian customers, and payment is being made by the customers to the foreign company. The letter of intent, which is like the final offer submitted by the Indian company to the customers in India, and on acceptance of the letter of only when that letter of intent is accepted, FO, which is foreign company, starts the shipment of goods to the Indian customers. Now this situation, would you consider the Indian company to be an agent, or more rather than an agent, would you consider the business of the company to whom income is attributable and is taxable? To my mind, if you can demarcate and create also documentation stating that Indian company has no role in this transaction except pure coordination, provision of information and price details to the customers in India, then the Indian company would not be considered as a business connection for the foreign company in India. There is, of course, the aspect of letter of intent, which is the final offer being given by the Indian company to the customers in India. But again, going back to 911, if you look at the agency business connection concept, it talks of three aspects of agency business. Or first and foremost, it says that the agent has to be a dependent agent. We assume here that the agent is a dependent agent. Even if we assume that, then there are three further aspects to the dependent agent concept which are required to be fulfilled in order for that dependent agent to be considered as a business connection, which is either there has to be authority to conclude contract or habitual conclusion of contracts. Now, in this case, even though the offer is being made by ICO, it is not concluding contracts. It is very clearly stated that the decision is being taken by FO. So if you can create documentation around this fact, then you can show that contracts are not concluded by ICO. The second aspect or the second limb is of securing orders. Again, orders are not being secured by ICO. ICO is purely providing information and is issuing documentation, which is the letter of intent to the customers in India. And the third is delivery of goods, storage and delivery of goods. So once again, storage and delivery of goods is not happening through ICO. So if it can be demonstrated that contracts are not being concluded by ICO and ICO is not securing orders, which appears to be the facts of this case study, then ICO will not be considered as a business connection for FO in India. And therefore, there is no question of 911 getting triggered or any income being attributable to that business connection in India. Okay, I would like to spend a few minutes here on the concept of significant economic presence, which is the amendment to the concept of a business connection or an addition to the concept of business connection introduced in last year. So significant economic presence is something which as of now, as the law stands today, as it is worded right now, could have a very, very wide implication when it comes to business connection. A significant economic presence in India is defined as in two parts or as two things. And it will be considered as a business connection if one, the first portion talks of transaction in respect of goods, services or property carried out by a non-resident with any person in India, including not any transaction will get covered. A transaction gets covered if aggregate of payments made during the previous year exceeds 2 crores. So if the threshold of 2 crores is crossed, then to that business will be taxable under the Act. The or engaging in interaction. Again, there is a threshold. Engaging in interaction with at least 3 lakh users in India. So if you are systematically and continuously soliciting business from at least 3 lakh users in India, or engaging in interaction with 3 lakh users in India, then again you have a business connection in India, and based on that business connection, your income attributable to that business connection will be taxable. Now let me come back to these 2 limbs again a little more in detail. So the first portion talks of the idea of significant economic presence when it was introduced was to target the changing mode of businesses which are done digitally or virtually without physical presence in India. The traditional concept of both business connection and permanent establishment are both linked to a physical presence. So either a factory or a branch or an office or an agent having storing goods in India. All of these are classic examples of business connection. So the traditional concept is a physical presence in India, and the fact that you have a physical presence enough to earn income in India means there is something attributable to India, and that portion attributable to India will be taxed in India. That was the concept. But with digitalization of everything, the way businesses are being conducted has changed entirely. Especially e-commerce has changed the entire scenario of how businesses are conducted. So a seller sitting anywhere in any corner of the world can have warehouses in a second country, in a different country, and can sell goods to customers in India just through the online interface of the website without actually maintaining any storage in India, without maintaining even a storefront in India, without having an agent in India. So all the need to have a business connection, or in terms of a DTAA, a permanent establishment in India or in any country for that matter, has been eliminated because of these digitalization of businesses. And that is where the seed for this concept of significant economic presence and also equalization levy has come into picture. So this is a part of the BEPS initiative of the OECD, where base erosion and profit shifting aspects are being looked into, and digital economy or the digital transactions is one very important aspect of the BEPS initiative. The suggestions under that particular action plan 1, which deals with digital economy, include equalization levy and this concept of significant economic presence, which India has already implemented in its own way. So significant economic presence, coming back to significant economic presence, what it therefore says is, if a non-resident has any transaction in respect of any goods, services or property with a resident in India, with any person in India, we're not even talking of resident in India. The other side of the transaction can be any person in India. So even if that person is in India temporarily, is not a resident in India, but the transaction happens in a way that the non-resident deals with a person who is physically in India, then it would be covered in this first aspect or first portion of the definition of significant economic presence. What is notable is it does not talk of digital transaction or virtual transaction. It does not talk of transaction relating to digital goods or services or property. It talks of a transaction in respect of any goods, services or property carried out by a non-resident with any person in India. And it includes, of course, the digital transaction of provision of download of data or software in India. If the aggregate of the payments made during the previous year exceed 2 crore, then it will be considered as a significant economic presence. So that means even a simple import transaction, if the threshold of 2 crores is crossed, will be considered as a significant you can consider the transaction of import and go and read the definition again. What does it say? A transaction in respect of any goods, services, or property carried out by a non-resident with any person in India if aggregate of payments during the previous year exceed 2 crores. Now, an import transaction exceeding 2 crores will fit within this definition, and therefore a mere import of goods by a person in India from a non-resident exceeding 2 crores will become SEP, will be considered as a business connection, and income attributable thereto will be taxable in India. So this has major implications when it comes to trade with India. So there is this one question which talks of your view on applicability of TDS on import freight. Okay, this freight portion will come back to. I thought the question was relating to imports. So that is the first limb of SEP. The second limb of SEP talks of systematic and continuous soliciting of business activities or engaging in interaction with at least 3 lakh users in India. So this would involve, to my mind, the classic examples of this would be any advertisement that happens through social media or any marketing that happens through social media. You are scrolling on Instagram, you come across an ad, you click on it, you buy something from the website. You don't know whether the website is in India, outside India. You just buy. When you're making the payment, you realize probably that, okay, it is giving an option of payment in dollar or rupee, so it may not be a website in India, but you go ahead and buy. Now that non-resident who is systematically and continuously putting up such ads on Instagram or on Facebook for sale of goods is soliciting business, and it is engaging in interaction with 3 lakh users, with users in India. So as an Indian user, when you are interacting with that Instagram page or Facebook page, and maybe buying any items from their website, that is creating a significant economic presence in India for the non-resident, provided the number of users exceeds 3 lakhs. So even the payment being made by you to such a non-resident through whom you are interacting on one of the social media pages is significant economic presence, and therefore that payment is liable to tax in India. So from your perspective, from the payer perspective, you are making a payment of a sum which is chargeable to tax in India, and therefore ideally Section 195 obligation should apply. But the reality would be that you will not be aware that the non-resident is falling under these criteria or not. You have no way of understanding if they are engaging with 3 lakh users in India or not. Any of their pages will only tell you how many total users they have. You will not know how many users in India they have, and therefore whether an SEP is there or not, a business connection is created or not, income is chargeable to tax in India or not, none of these you are in a position to verify. But technically speaking, this provision could get triggered even in very common day-to-day transactions. SEP, the definition clarifies that it applies irrespective of whether there is a contractual or territorial nexus in India, which means whether or not that person is resident of India, like I mentioned earlier, whether or not there is a contract with customers in India. If the definition of SEP is satisfied, it becomes a business connection. Income attributable, I said, whatever once SEP has been determined, income attributable to those transactions is deemed to accrue or arise in India. There is explanation 3A further, which adds to or expands to the definition of SEP to some extent, where it says that income attributable in case of SEP will include income from advertisement which is targeting a customer in India, or customer accessing advertisement through IP address located in India. It will include income from sale of data which is collected from a person residing in India or who uses IP address located in India, and sale of goods or services using such data. So if I have to give just quick examples, advertisement targeting a customer in India or customer accessing the advertisement through IP address located in India is the same thing that I spoke about the Instagram ad. So if somebody has put up an ad on Instagram and you are, as a user in India, you are coming across that ad, clicking on that ad, going to the website of that seller. Now, whatever that Instagram page is paying for that advertisement, the income from that advertisement, which is being paid to whom, which is being paid to Instagram, or for that matter, the parent, which is Facebook. So the income from advertisement generated by Facebook for targeting a customer in India, which will be included in income attributable to transactions in India. Not just that, all the data which is collected from every time you access these websites or click on some page or even like a post, the data is being continuously collected as to what you like, what type of content you usually see, and accordingly other posts are being shown to you. So data that is collected when you are accessing all these social media websites is available with Facebooks and other social media pages and Twitters and everybody, which can be sold to businesses who want to use this data to target you, to target advertisements towards you, to sell you products. So when Facebook and Twitter and other pages are selling this data to businesses, then sale of that data is also included in income attributable to activities or transactions in India. And lastly, when the businesses who have purchased this data are targeting you for advertisements, are selling you their products through their ads, then income from that sale of goods or services will also be considered as income attributable to the transactions relating to SAP. So it covers the entire ecosystem where the person who is selling you goods and services, the person who is selling data to that business, the person who is targeting advertisements to you, everything is considered as income attributable to transactions or activities in India, assuming, of course, the threshold limits of 3 lakh users is satisfied. Now, all of this is significant. The concept of significant economic presence itself is under the Act and not under the DTAA, which means if you are, if the non-resident has access to a DTAA, is eligible to apply provisions of a DTAA, then all of this headache of significant economic presence goes away. But in transactions where a DTAA is not available, or the non-resident is not eligible to apply the DTAA, then you will have to consider all of this under the Act. These were the issues that I listed broadly. There is no definition. What do you mean by provision or download of data or software? There is no definition of what is systematic and continuous soliciting. Then the threshold value for sale that has been defined, which is 2 crore rupees. Whether you'll consider the gross sales, whether you'll consider the discount offered. What about the credit period? So for instance, if I go back and look at SEP, the first portion, it says 2 crores is not the value of transaction. It says if aggregate of payment during the previous year exceeds 2 crores. It doesn't say aggregate of transactions exceeds 2 crores. So because of credit period, if my transaction value in a particular year exceeds 2 crores, but I've not realized the payments, part of the payments are being realized in a subsequent year. And so in that year, the collections are not crossing 2 crores. Will I apply SAP or will I not apply SAP? Then there are other issues surrounding the user base. So the 3 lakh users in India, it doesn't talk of residential status. It only says users in India. So that would even mean temporary users in India, foreigners visiting India, either for travel purposes or for work purposes. If they are accessing something through India, will they be considered users in India? If yes, then for some part of the year, they'll be users in India. For some part of the year, they'll not be users in India. How do you deal with that? Also, how does the person, the non-resident who's interacting with the users, come to know whether the interaction is being done with users in India or not, except for the IP address. So will they then have to track and maintain data of all IP addresses accessing their pages, accessing their websites, as to demonstrate how many users in India they are interacting with? That will be massive amount of documentation that will be required. Again, when they say users in India, are they talking of active users, or passive users will also be included? A lot of times you can have people just liking the pages or following the pages, but then there is no interaction. They are passive users. They hardly ever visit the page and see what is happening. So will those users be counted? All of this, there is no clarity as of now, and therefore it becomes very complicated if you have to apply the SEP provisions in the absence of a DTAA. So I spent some time on the SEP provisions mainly because these could have very far-reaching effects, and I wanted you all to know that these kind of provisions exist and be aware of this. Commission to agents abroad. I think I will not go very deep into this. There can be some discussion around this, but broadly, in case of commission which are being paid for to agents abroad for getting export orders, etc., what you need to look at is where are the activities performed, and is that income? Can you say that that income is getting accrued in India or not? That will be the basic. So if all activities for getting the export orders are being performed outside India, the base of the agent itself is outside India, and from contacting customers to documentation, everything is outside India, then you could say that the commission which is paid to agents for getting those export orders is not taxable in India. We had circulars 23 of 1969, 163 of 1975, and 786 of 2000, which all clarified that these commissions are not taxable. Those circulars have since been withdrawn. But withdrawal of circulars does not by itself mean that those payments become taxable in India. It only leaves the room open for examining the case on the basis of facts. But if your facts are clear that the activities are entirely performed outside India, then there is no reason for that amount to be taxable in India, purely because the exports are being made from India or the supplier is in India. That is no basis for taxing the amount. Provided, of course, those activities should not result in FTS. If they result in fees for technical services, which is they are either managerial consultancy or technical in nature, then in that case, you will have to look at the FTS taxability, which if the payment is being made from India for the purpose of business in India, then FTS becomes taxable in India. So again, just a quick connect back to the concept of SEP. Now this commission agent, assuming it is not FTS, is performing activity outside India. Now, if you look at the first limb of SEP, it said transaction in respect of any goods, services or property. It did not say sale of goods. It did not say sale of goods, services or property. It simply says transaction in respect of any goods, services or property. Now, even this commission agent's activity will get covered and the transaction in respect of goods, services or property, which means if that crosses the threshold of 2 crores, then even the commission agent's activities will create a SEP in India on a literal reading of the provision. And that all of this unsettles the already settled understanding and interpretations of law, and creates a lot of, or has the potential to create a lot of chaos for the existing transactions that we have been assuming to be treated in a certain way all along. Indirect transfers, I think I will skip. primarily relating to the Vodafone situation and similar other situations where if you have assets in India which are contributing to more than 50% of the value, then sale of shares outside India of an entity outside India will still be taxable in India. Salary deemed to accrue or arise in India if services are rendered in India, or if they are paid by the Indian government to an Indian citizen, even if services are rendered outside India. Okay, there was one question on freight earlier. Your view on applicability of TDS on import freight paid by non-resident shipping agents, paid to non-resident shipping agents. Since circular of 1995 only clarifies non-applicability of TDS on export freight to non-resident shipping agents. Okay. So this is the other part. We discussed the commission on exports, or we also similar would be the situation on export freight, which 1995 circular clarifies. But what happens if the freight is being paid by import, paid for the purpose of import? Now, to my mind, simply change from export to import doesn't change the taxability. You have to look at for that import freight, what is the service rendered and what is the location or the situs of that service rendered. So in case of import freight, which you are paying to non-resident shipping agents, when you are importing goods, where does the responsibility of that shipping agent conclude? Does the responsibility of the shipping agent for the goods come to an end outside India only? The moment they have loaded those goods on the ship or on the cargo, their responsibility with respect to the goods comes to an end, then you could say that the services are rendered out entirely outside India. There is no question of taxability of such payments in India. But if the terms are such that the non-resident shipping agent is responsible not just for loading goods onto the cargo outside India, but also coordinating in India and ensuring unloading of the goods in India, then a part of the transaction gets concluded in India. There is a service or a activity undertaken in India, which definitely attracts some, gives rise to some income. And therefore, you will go back to understanding what is the income attributable to that element of activity undertaken in India, and accordingly, we'll have to evaluate the taxability. Again, salary, there are a lot of other aspects. Expats who are working in India but continue to retain their salary or their rather their job with employment with the foreign entity. How do you treat them? In case of expats, again, that is a topic by itself, expatriate taxation. But broadly, you will look at, try to understand if they are economic employees of India, or rather the other way around. If even though they are the foreign entity is a legal employer because they continue to be on the payroll of the foreign entity, but is the Indian entity the economic employer of those employees, in the sense that are they following all the rules and regulations that apply to employees of the Indian entity, including the timing, the dress code, the manner of rendering services or manner of conducting their duties, etc., the holidays. If that be the situation, then they can be considered to be economic employees of the Indian entity, which means salaries that are paid to them should be taxed as salary under section 192. So that again, like I said, that's a very wide topic of discussion by itself. But broadly, in terms of salary payments, what needs to be looked at is one, where is the service being rendered? Is the service being rendered in India or outside India? Two, where is the salary received? And three, who is your employer? Are you employer of the Indian entity economically, not legally, or are you employer of the foreign entity? And accordingly, the taxability of that amount will be determined. So if you are in case of salaries which are paid, or the reverse situation also, where employees of Indian entity are posted in a different country for maybe a couple of years, then how do you evaluate the salary, the taxability of the salary paid to them? You are an employee of the Indian company, you continue to retain your employment with the Indian company, as a result of which you will probably receive some nominal salary also from the Indian company, but you're posted outside India. So you are legally an employee of the Indian company, but the same logic applies. Are you an economic employee of the Indian company only, which means are you continuing to follow all the rules, regulations of the Indian company? Are you continuing to report to your bosses in the Indian company only? Or are you really working as an employee of the foreign company where you are posted, following their rules, regulations, their timings, their holidays, and reporting to bosses in that entity? In that situation, you can be considered as an economic employee of that entity. Your salary received from that entity will therefore be taxable in that country and need not be taxable in India, especially if you are a non-resident from Indian tax perspective. You will have, of course, this I'm discussing purely from the act point of view. To add to this, you will also have to look at the position under the DTAA. What does the DTAA say about personnel payments? You have a separate article which deals with salary payment, and whether you fit in criteria as per the DTAA for India not to tax that particular payment. Interest, royalties, and FTS, some of the most common transactions fall under this category. Quickly, broad rules for all three are similar. If they are paid by the government of India, deemed to accrue or arise in India and therefore taxable. If they are paid by an Indian resident, by default deemed to accrue or arise in India, unless it is for a business outside India or a source of income outside India. And the reverse, if they are paid by a non-resident, they will be assumed to or deemed to accrue or arise in India only when they are for the purpose of business in India or source of income in India. So in these three categories, if they are taxable in India, all these three incomes have a flat rate of tax on gross basis. So they will be taxed at that rate which is prescribed under the respective provisions for these sections. So gifts by non-resident to residents are now taxable. It is deemed to accrue or arise in India by residents to non-residents. So they become taxable. There is no rate of tax prescribed in such a situation. And for that matter, many other incomes, there is no rate of tax prescribed. So depending on who you're paying to, if you believe that entire amount is not taxable in India, then you go for the lower TDS determination. If that is not the situation, the amount is taxable, but you do not know what rate of tax, then you will have to deduct tax at source. As a payer, it is advisable to deduct tax at source at the maximum marginal rate which is applicable. So if you are dealing with an individual, the maximum marginal rate would be the 30% plus applicable surcharge and cess. If you are dealing with a foreign company, it would be 40% plus surcharge and cess. Equalization levy, again broadly introduced to deal with digital businesses. Two types of equalization levies exist. One is payment in respect of online advertisement or provision of digital advertising space or facilities for the purpose of online advertisement, etc. So basically, payment to Facebook or Google for online advertisements are all subject to equalization levy, assuming the payment is made to a non-resident or a foreign company. Most of these also have Indian entities, and if you are making payment to the Indian entity for the online advertisement, then equalization levy doesn't apply. The normal domestic law provisions apply. So if the threshold of 1 lakh is exceeded, then an equalization levy of 6% applies on the gross amount. The mode of discharge of equalization levy is largely similar to TDS, just that this is a provision created by Finance Act 2016, but kept outside the Income Tax Act, with the intention that if it is outside the Income Tax Act, it will not be negated by DTAA, because otherwise everything that is introduced in the Act, if a parallel provision doesn't exist in the DTAA, then it doesn't become taxable under the DTAA, and therefore the purpose of that amendment is lost. So equalization levy was purposely kept outside the Act. There is also the additional equalization levy, or the new equalization levy introduced by Finance Act 2020 on e-commerce activities, where any consideration which is received by a non-resident operator for online sale of goods or provision of services or facilitation of online sales is taxable at 2% of the gross amount. Now here again, you have the definition expands to include sale of advertisement, sale of data, or supply of service using IP address located in India, which is similar to what we saw in SEP. Now, it becomes, when it comes to equalization levy, whether it is 6% or 2%, you have to be very careful in understanding what will come first. Will equalization levy get the preference, or there could be in a lot of situations an overlap with the provisions under the domestic law, under Income Tax Act itself. So will you give a preference to equalization levy, or will you give preference to the domestic tax provisions? Because like we discussed earlier, 10 subsection 50 exempts from income tax any payment which is subject to equalization levy. So we have to be very, very careful if EL applies or not, because EL on advertisement transactions is 6%, on e-commerce transactions is 2%. If you decide, or if you come to a conclusion that EL applies, there's a possibility that the rate of tax under the normal provisions may be higher than EL. And therefore, you do not, by not applying normal provisions, if the tax authorities take a stand that normal provisions apply, EL does not apply, then you may end up being non-compliant to the extent of the short tax that has been collected. So you have to be very, very clear. To my mind, equalization levy is more specific than the provisions under the Act, and therefore you should go by elimination, identify whether a certain transaction falls under equalization levy or not. In fact, you can look at section 10 subsection 50 also. It says that an amount which is chargeable to equalization levy will be exempt from income tax. So even 10 subsection 50 makes it clear that you have to first look at equalization levy, make sure that it applies or does not apply, and only when you are out of equalization levy will you come back to taxability under the Act. So first examine the EL provisions, and then if you are out of the EL provisions, examine the normal domestic tax provisions. When you are making these payments, what conversion rate has to be applied? In the context of gift, the question is, gift to specified relative will be exempted? Yes, of course, the provision of exemption will be there. So conversion rate that has to be considered has to be as on date when the tax is required to be deducted at source. So because your TDS provision applies on the date of payment of credit, whichever is earlier, your exchange rate on date of credit and date of actual payment can be different. So the rate that you have to use for calculation of tax amount has to be the rate as on the date when tax is required to be deducted at source, which is payment of credit, whichever is earlier. Subsequently, if the rate fluctuates when you actually make the payment or when you book the transaction for which you made an advance payment, then you cannot keep revising the TDS amount accordingly, or you cannot keep adding the TDS amount accordingly. So if the rate changes, the difference has to be ignored. Rate of tax, I think we did a brief discussion on this. Grossing up, like it applies to domestic TDS provisions, also applies to 195. Grossing up will happen if you have a TDS DTAA provision also applying and rate as per DTAA. Grossing up has to happen as per the rates in force. And if 206AA applies, grossing up will not consider 206AA. You have Bosch Bangalore Tribunal also to this effect, which says 206AA grossing up doesn't have to be done based on 206AA rate. TRC. Okay, we also had some question relating to TRC. This is one of the primary documents which is required to avail benefit of DTAA. You have section 90 subsection 4, which says you cannot avail a DTAA benefit without a tax residency certificate. And you also have 90 subsection 5, which says that if the TRC, it says you have to, the assessee has to provide these details. Rule 21AB gives you what details have to be provided, and it says that if it gives you a list of 5 information, which is name, address, their registration number or their tax identification number in the other country, the period for which the TRC is valid, etc. If all of these information is not appearing on the TRC format, because each country has their own TRC format, then the non-resident also has to provide Form 10F. Form 10F is not a substitute for TRC. A TRC is the primary document. If the TRC doesn't have all details, then 10F is needed. So 10F alone is not sufficient to claim the DTAA benefit. What if the TRC is not available at the time of deduction, which happens a lot of time? A client has to make an urgent payment, TRC is not available. How do you deal with that? Now, in principle, on a principle level, if you look at, and plus the Ahmedabad, you have the Ahmedabad Tribunal in case of scarce industries, which also says the same. Section 90 subsection 4 cannot override the DTAA. A domestic law provision cannot unilaterally override the DTAA. So if it cannot override the DTAA, it also implies that the TRC is not necessary because there is no mention of TRC under the DTAA. So as long as the non-resident is eligible for DTAA as per the DTAA provisions itself, there is no need for TRC. But this would be an extreme stand to take practically. It is advisable to obtain the TRC at the time of deduction. Worst scenario, if the TRC is not readily available, you could also find a way out practically by looking at 2 additional things, which is one, if a TRC is available for an earlier period, then rely on that TRC and ask the vendor or the payer, the payee to obtain TRC for the current period and share with you at least some proof or some acknowledgement of their application made for the current period. So the 2 combined, which is TRC of an earlier period plus application for TRC for the current period, can give you comfort that this payee is surely a tax resident of a particular country and is eligible for the treaty benefit. Based on that, you could decide to go ahead with availing the treaty benefit if the situation demands. You should not take this stand for every situation, but on an exception basis, if the situation demands, you could try and accommodate on this basis after reasonably verifying that the non-resident is eligible for the particular treaty that you are applying. If a treaty is available but for a different period, again, same thing. If it's for a different period, it is not really a valid TRC. You need a TRC for the same period. So ask the payee to apply for a TRC for the same period. And is TRC required if tax is not payable under the Act itself? TRC, the purpose of a TRC is to take the benefit of the DTAA. If tax is not payable under the Act itself, there is no question of any better position or any beneficial position under the DTAA, and therefore a TRC is not really needed. Again, same discussion, it is necessary. So there is also this aspect of TRC being a necessary document, but not a sufficient document, which is the other angle. You need TRC to avail DTAA benefit, but TRC alone is not enough. Now, this proposition is coming into play because even after producing TRC, which in a lot of countries is being issued mechanically, you come across a situation where the entity is not really a beneficial owner of that amount, or is not really a tax resident of that other country in substance, and therefore the benefit of the DTAA should not be allowed. For instance, a Singapore incorporated entity by itself doesn't become a resident of Singapore. You have in the India Singapore DTAA, you have the limitation of benefits clause, which gives you additional conditions to be satisfied by the Singapore entity in order for the India Singapore treaty to be applied. So mere TRC will not demonstrate whether those conditions are satisfied or not. Similarly, you could be making payment to company X in, let's say, UK, but it may be made on behalf of company Y in US. Then TRC, just because you are making payment to the UK entity and obtain TRC from the UK entity and you apply India UK DTAA, the beneficial owner of that payment, if it is not the UK entity, then that whole analysis of applying the UK treaty based on the UK entity's TRC would be would not be appropriate. So based on the concept of beneficial ownership also, a lot of different or contradicting stands have been taken by judicial authorities, stating that merely producing TRC is not enough. You need to go into facts and understand whether that entity is the beneficial owner of the amount that it is receiving or not, whether that entity is really eligible for the treaty based on any local additional conditions levied under the DTAA or by the local government for being treated as a tax resident of that country or not. And after understanding these facts, you take a call whether that entity is eligible for the DTAA. Now, all said and done, this sounds good in theory. This sounds very principle oriented in theory. But the fact is that in practice, as a payer, when you are advising your client who is remitting the money outside India, how do you verify beneficial ownership? How do you check whether the principal purpose test under the DTAA is satisfied or not? How do you check whether the limitation of benefits clause under the DTAA is satisfied or not? You may not, even if you ask for information to verify all of these, the vendor is not going to share all of that information with you for a mere payment of a trade transaction. The limitation of benefits clause may have conditions like the India-Singapore clause has condition of annual spending of the entity and number of local directors and all of that. So the vendor or the payee may not share all of that information with you. So in that situation, what does the client do when they have to make the remittance? The probable way out is to obtain a declaration from the non-resident that they are beneficial owner of the amount that they are receiving and that they are eligible for the benefits of the DTAA that is being sought to apply. 206AA, I think in the context of domestic TDS provisions, we all understand how 206AA applies. Higher of rates in force, a rate as per the relevant provision or 20%. Surcharge and cess does not apply on 206AA. There is some discussion on that going forward, but in a nutshell, 206AA rate, if 20% rate is applied, surcharge and cess does not apply. If 206AA 20% rate is applied, again, grossing up will not happen at 20%. We have the Bosch Bangalore Tribunal decision, which says grossing up has to happen at rates in force. So you will gross up as per applicable rates in force and then deduct TDS at 20% on that. Exception to 206AA in terms of non-resident payments is Rule 37BC, which says that if the payment is in the nature of interest, royalty, FTS or capital gains, which is 4 types of payments, then and the TRC of the country, if the country issues TRC, is being provided, plus other details like name, email ID, contact number, TIN, address are all provided, then 206AA will not apply, which means 20% rate will not apply. Now, this is a good thing, and interest, royalty, FTS, capital gains are the most common transactions. So it really helps in those transactions that merely on the basis of TRC, even if PAN is not there, higher rate will not be applied. For other transactions, it doesn't make a lot of difference, because typically for other transactions, a flat rate of tax is not prescribed, which means there's a high possibility that the taxability will be at MMR, which will end up being higher than 20% rate of 206AA. So that in those situations, 206AA any which ways has very little role to play. So can DTAA rate be applied if it is lower than 206AA? There are both views. We have Delhi High Court and other decisions also, which say that treaty provisions will override both charging and machinery provisions of 206AA. Or in other words, you cannot unilaterally override treaty provisions by introducing a provision under the Act. Which means if treaty provisions are lower than 206AA, then treaty provisions will apply. But then practically, in order to apply treaty provisions, you need TRC. If you have TRC, in most of the cases, any which ways you will come out of 206AA after the Rule 37BC was introduced. So it's not really a significant thing. But there is an alternate view also which says that DTAA provisions, DTAA is meant for final taxes and not for TDS provisions, which means you will have to apply the domestic law for a TDS and maybe claim a refund later. This is somewhat in line with the PILCOM decision of the Supreme Court. But to my mind, if you have TRC, you can access DTAA, and you are any which ways outside 206AA if you have the TRC. Grossing up, we discussed. I will skip this slide and go to the next one. Interaction between 206AA, PAN, TRC. So under the Act, you will have to check, is it taxable? Is PAN available? Then 206AA does not apply naturally. Is it covered under 37BC? Then again 206AA doesn't apply. And only when 37BC do not have PAN or TRC, then 206AA applies. Similar, under the treaty, what happens if it is taxable as per the DTAA or DTAA rate is beneficial, then you check whether TRC is available and 10F is available. TRC or 10F is not available, then you will not apply treaty rates. Again, you come back to the domestic provisions, check whether PAN or 37BC details are available. If yes, then treaty rates apply. If no, then would you apply treaty rates or higher of 20%? So if PAN, if TRC is available, to my mind, the DTAA rate should be possible to apply. The impact of non-deduction, we are broadly aware. Just to touch upon, there could be interest on delayed deduction, delayed payment, and other penal and prosecution consequences. Plus, there will be disallowance of expenses if it is business expenses under 40 subsection small a, or if it is other expenses claimed other income against income from other sources, then under section 58 there will be a disallowance. And the payer could be considered as a representative assessee. We have that relief under 201, which was also available for resident payments, which is now available since 2019, September 2019, to non-resident payments also, where if the non-resident has paid tax and gives a declaration to that effect or a certificate to that effect to you, then you are not considered as a assessee in default. Disallowances, I'm not getting into the details. Penalties, other consequences, representative assessee. 195(6) talks about submission of Form 15CA and CB. So 15CB would not be needed where you have a certificate AO or 195(2) or 197. Then in that case, based on the AO certificate or order, you can file 15CA and submit the same to the bank. Other cases, 15CB is issued by the CA, and based on that 15CA, 15 CA, there are 4 parts. We know. So theoretically, this is what happens. You need 15 CB only for part C. You do not need 15 CB if you are going for part A, B, or D of 15 CA, which is either the amount does not exceed 5 lakhs or the amount is taxable, does not exceed 5 lakh, exceeds 5 lakhs, but you have 195.2 or 195.3 or 197 certificate. Or the third part is where the remittance is not taxable under the act at all. In those 3 cases, 15 CB is not required. But practically, when interacting with the banks, we come across situations where a lot of payments, if they are, even if they are not taxable, 15 CB is asked for because the bank is not in a position to verify that they are not taxable. For instance, reimbursements, the bank is not able to verify that they are not taxable, so they ask for 15 CB certification from us. Similarly, the payments not exceeding 5 lakhs. Typically, if the payments do not exceed 5 lakhs, then in that case, part A applies, 15 CB is not needed. But the banks are not going by this threshold of 5 lakhs because they do not know the aggregate threshold, or they do not have a track of the aggregate threshold for the year. And again, 15 CB is asked for and issued by us. I'll take a couple of questions here relating to 15 CACB rather than go on with the remaining portion of the presentation. So if we are making payment by non-resident to credit card, whether we are required to file 15 CA, assuming there is no TDS deductible. So these contention was maybe TDS may not be there. Documentation, but the payment happens directly. There is nobody to check whether TDS is deducted or not, nobody to check whether 50 CPs are done or not. Payments are just made online through the payment gateways. Typically, all obligations that apply to a payment made through banking channels also apply to payment made by credit card, which means if making a payment on which TDS is not deductible, but your 15 either because it is in the nature of reimbursement, etc., where it cannot be clearly ascertained that TDS is not deductible, then 15 CACB both are required. Then 15 CACB should also be issued when payment is made by credit card. Same would be the situation for 15 CA, where TDS is not deductible, but through normal banking channels, when you're making the payment, you are generating 15 CA Part D, then even for non-credit card payments, the same should be done. If the amount is reimbursed to employee in INR, whether TDS provisions are applicable for expenses made by employees. So, okay. Here, so what we are trying to say is there is a reimbursement payment where employee has made the payment first, then those amounts are reimbursed to them in INR. Now the currency, first of all, the currency would not be relevant whether you are reimbursing in INR or not. What is relevant is that you are booking that expense in your books of accounts, and it was you who was liable to make that payment in the first place. But instead of you, for whatever reason, because a credit card payment was easy, or because the employee urgently needed to make that payment, you made the payment. And then because subsequently it was reimbursed by the company to the employee. So the primary responsibility of that payment is of the Indian entity. Now, if had the Indian entity done that transaction directly, was TDS applicable or not is the question you should be asking. If yes, then the Indian entity is under obligation to discharge the TDS obligations payment as well as reporting subsequently. How you do it practically is of course a question of some difficulty because the payment to non-resident has already happened employee, which means there is no way for you to deduct TDS from the payment being made. There is no way for you to understand which country that non-resident belongs to or ask for TRC or Form 10F. So if the amount is material and substantial and had you made a direct payment TDS was applicable, then it is advisable to in order to discharge the obligation under 195, it is advisable to, with whatever information you have on hand, that is no TRC, no 10F of the foreign entity, understand assert whether it is taxable or not. If taxable, because no TRC, no PAN, nothing, apply 206AA, cross it up, and discharge the tax liability on the pocket of the Indian entity. That would be the safest or the most conservative way about it, especially if the amounts are material. When reimbursement is made to a group company for professional fees paid outside India, again, Gautam, the answer to your question is the same. Any reimbursement, the thumb rule is, had the transaction been taxable directly, you need to tax it indirectly also. How the difficulties in compliance will arise? Yes, of course, because when you're making payment to group company, again, you don't have data of the third party. You don't have their PAN, TRC details. You don't whether they have a P in India or not. So you assume whatever information available to you, you determine the taxability, and probably because the third party is no longer going to bear the tax, you cross it up and make the payment of the tax. In case of netting off of transactions with group company, whether TDS needs to be deducted, while I think these are two completely different things. Netting off of transactions doesn't change the nature of the transactions. It's only a way of settling the transactions. There is a payable, there is a receivable to the FEMA provisions. You decide to settle it, change TDS. You still need to from India, whether the income leg for the non-resident is attracting TDS or not. If yes, TDS needs to be done and all subsequent compliance needs to be done. Recipient from TRC will not get TRC and also no PAN. Recipient from Dubai will not get TRC and also no PAN. Does it mean TDS at 20%? Kiran, TRC is now being issued by Dubai authorities. They have a special link. The UAE has a link for issue of TRC to Dubai residents, both individuals and individuals. And therefore, I think it is possible to obtain a TRC and come out of the 206AA 20% rate. Chetan bhai, your question on applicability of 206AB. 206AB, I understand, is on the TCS provisions, and TCS provisions per se are not relevant in case of Section 195. Section 195, we are dealing with payments being made to India and
No. Namrata, 206AB is for TDS, not TCS. TCS is 206 CCA.
Achha, yeah, I read your question about 206 AB and CCA. So 206 CCA, my bad, will not apply. 206 AB would be.
Namrata, the problem is they have provided that if non-residents have a P in India, then only 206 AB is applicable. If they have don't have any P in India, then 206 AB is not applicable. But the problem is that the non-resident is not giving no P declaration, and he is also not having PAN. So whether we have to deduct TDS, C is taxable at 30%. So 60% plus surcharge plus education cess, his maximum assessment rate is 30%. But TDS, I have to double the rate. So whether 60% will be deducted, I mean, I will be allowed to deduct, or whether we go by that maximum rate chargeable to tax in India is 30%. So
no,
to deduct
so
60% or 30%.
See, so of course the bottom line is 60% or 30% MMR or the double the rate. But if your provision is asking you to comply with a certain documentation and demonstrate that the foreign entity has PE or not, doesn't have PE in India, then you will not be able to take a call of the lower rate or applying the rate as per the rates in force or the maximum marginal rate if entity has a PE in India. So if the vendor is not ready to provide you a no PE declaration, then you will have to, from the payer perspective, from your client perspective, you will have to err on the side of caution and comply with the other. eventually what will happen is when you undertake the subsequent compliance of filing the TDS returns, etc., you will end up being penalized for that difference of tax yourself.
Agree.
So
My problem is the maximum rate is chargeable to tax in India is 30%, whereas I am deducting TDS at 60%, which is illogical.
Right. Yeah, I agree. So I think that irrationality was also taxable at 10%. I am because 2.6 I am deducting TDS at 20%. So that same problem of irrationality of the provision existed even in 206AA. But the bottom line is you look at one illogical higher reduction of TDS, and the non-resident, of course, has the option to subsequently obtain PAN, file a return, and claim the higher TDS because they have in the first place not confirmed to you the status of the PE, etc. Or you take a chance, you go by the lower rate of 30% without getting a confirmation on the PE from the non-resident. And probably if it comes up for scrutiny for some reason, or if when your TDS return is filed and the process at the time of processing the TDS return, that query comes up, then the differential tax, which is a substantial sum of 30%, will have to be borne by the Indian payer. So this, I understand the difficulty in non-residents sharing documents and in obtaining the no PE declaration. We've dealt with these situations. We keep dealing with these situations in different payments, even the regular ones. But despite that, I believe compromise on documentation and taking a call for a lower TDS is only opening you to possible potential future liabilities, not just the liability. You then tend to become an assessee in default, and all other aspects of assessee in default also get attracted. The penal and prosecution consequences also come into play. So a lot is at stake when you are compromising on the documentation portion.
No, my problem is that the rates in force will be the 30%. His assessment rate is 30%, but I am deducting at 60%.
Right.
But the rates in force will not restrict you to 30%.
No, that is the whole intention of sections like 206AA and 206AB to collect a higher TDS than the applicable tax, so as to bring the recipients in within the tax net, to bring them to get them to obtain the PAN or registrations, etc.
I agree, but section
That is the
115.
idea.
Namrata, the section 115 itself says that non-resident is not required to file TDS if the appropriate rate tax has been deducted.
I am, yes. No, I am aware of that, Chetan Bhai. Section 115A is there. Then you have the provision which says that non-residents cannot be made to obtain PAN in India. That controversy has been there since the time 206AA was introduced. That non-residents are not needed to obtain PAN in India. They can not be mandated to obtain PAN in India.
Right.
And still, on the other hand, 206AA has survived so many years, more than a decade, if I'm not wrong, and continues to be in place, nearly a decade, not more than a decade. So this is how the situation is. You from a payer perspective, you will have to look at your obligation, which is of tax reduction at source, and you will have to safeguard your interests. It is then if you're evaluating from the non-resident's taxability perspective, and you're saying that 115A says they don't need to file the return of income if TDS is deducted, then the non-resident has to ensure that the documentation is complete so as to not trigger the higher rate of tax.
Correct. Namrata, the problem is that it's all gross up kind of a thing. So
I understand. So then the gross up gives you a much bigger liability.
Right. Okay, thank you.
Okay. Yeah. So there was some. Okay, examples of there's a query on EL examples where EL at 2% is leviable on e-commerce operators. How will non-resident operators discharge this liability, and will that liability come on resident payers? The liability doesn't come on resident payers, but the EL, like I mentioned Bhavesh earlier, is in operation similar to TDS, which means like TDS is deducted when making payment to non-resident, EL is also deducted when making payment to these non-residents, either for advertisement at 6% or for e-commerce, and 2% liability has to be discharged by the resident when they are paying to the non-resident operator for supply of goods or services or facilitation of that supply of goods or services. So, in example, if I have to give you, let's say, if there is a B2B website from where you are buying goods in bulk, and it's a website which is operated by a non-resident operator. Buying goods in bulk, if you cross the threshold that is given.
I think Namrata got dropped. We'll just check at our end.
Namrata, you are on mute.
So I'm not sure, some issue and I got dropped off. Quite a few questions I tried to address. I think there are more, but we've also overshot. We are already at 7:30.
Only one thing, Namrata, the last part, what you discussed about EL or at the rate of 2%, what I understand is section 166A of Finance Act for Equalization Levy. It says that EL at the rate of 2% should be paid by the e-commerce operator and not the non-resident, the resident payer. It's not deductible like the 6% EL.
Yes, it is for the e-commerce operator that the EL applies. That's right. I misconcluded by saying both of them are connected, but it is for the e-commerce operator. So the e-commerce operator has to discharge that obligation by making the payment of the EL and also undertaking that form, filing the forms relating to EL.
So will that liability be on the resident payers in case if they don't pay the non-resident e-commerce operators?
Will the if the e-commerce operator doesn't pay? No, I do not believe it. This would operate similar to the TDS provisions. See, in case of TDS provisions, where the tax is not discharged by, where you have in the first place missed making the payment and the tax is not discharged by the non-resident, there are two aspects that make the resident payer responsible. One is you have the concept of assessee in default. because you have not deducted tax at source as is required, you become an assessee in default unless you can demonstrate and you obtain from the non-resident the certificate which states that they have paid the necessary taxes. So unless you can demonstrate that, you become the assessee in default. Second, you have section 163, which specifically deals with the concept of representative assessee, wherein they state that the out of the different limbs of section 163, one of the limbs is where any person who is from whom the non-resident is receiving an income becomes a representative assessee. So in the context of TDS provisions, you have these specific provisions which come into play, which link the resident payer to the transaction and to the non-resident, making them responsible for the liability. Now, in case of EL, what happens is, one, EL is outside the act. So the concept of representative assessee doesn't directly apply when you talk of equalization levy. Now, the obligation of EL is on the e-commerce operator for the 2% EL. And if a resident payer has paid to the non-resident operator for the online purchase of goods or services, etc., it is not within the or it is rather practically it is difficult that the non-resident payer would have an idea of whether the non-resident e-commerce operator has discharged his obligation or not. So to bring the liability back onto the resident payer for the non-resident not discharging EL, according to me, would be inappropriate and can be argued against.
Okay, thanks.
Yeah. I think there may be a few more questions, but maybe you could just download them. I could download them probably, and whatever questions remain can be responded to later.
Yes.
Looking at the time.
Correct. I think we'll wind it up, and you maybe we can share your email ID and participant can mail you if there are any more detailed queries along with them.
Yeah. That is my email ID.
Yeah, we can then roll it out on the WhatsApp, not
sure.
Along with the presentation.
Yeah.
Yes. So coming to the pleasant task of vote of thanks, I think Namrata has done a fantastic job, and yes, for non-residents and international tax, she is always the preferred speaker at the other CP study circle. I, on behalf of all the members and all the participants, thank you, Namrata, for accepting our invitation and guiding us through the non-resident provisions. I think lots of queries have got resolved and many more may be there, but yes, we'll definitely try and get them resolved too. So thanks a lot. Thank you everyone for your active participations, and thanks a lot, Namrata, again for coming and giving your valuable time.
Thank you, Pareen. And thank you, the other CP also for this opportunity and for the even if virtually, for the opportunity to interact after such a long time. Pareen, just one thing, I am not able to download those chats, the questions that remain. So if you could,
I'll do that.
Yeah. Okay. Thank you.